When stock markets take a tumble, there is always a rush of experts offering helpful tips. Don't panic, markets don't go up in a straight line. Remember, investing is a long-term game, is the general gist. And that is all good advice. If you pay heed to such sentiment and invest over decades, then you will almost certainly end up richer. It is entirely natural for markets to correct by 5 to 10% on regular occasion, but investors have a habit of panicking when the markets wobble. They sell low and buy high. But invest for long enough, and you may also note something else. That same advice to hold on also gets dished out when the stock market really is crashing. If I cast my mind back long enough, I can remember similar guidance in 2008, when the FTSE 100 eventually lost 47%. I don't doubt that this was also the case as the dotcom boom turned to the bust, leading to a 50% decline. The last proper big fall for UK shares came between April 2015 and February 2016. It was more minor, but still brought a 20% slump. There is only one that I think could work, albeit I have never put it into practice myself. In essence, it is very simple and uses a basic trader's tool, the 200-day moving average. The moving average adds all the closing prices over the time period and divides the sum by the number of prices used, so in this instance 200 days, and generates a trend line. The 200-day moving average is widely used as it creates a fairly stable trend. If the price falls through the line of the 200-day moving average and stays there, then you sell. When it moves back above it and stays there, you buy. While you will not get out at the top or back in at the bottom, following this rule would help you dodge much of a crash and reap most of any gains. The chart above shows the 200-day moving average against the FTSE All-Share Index over the past 10 years. The rule would have helped you escape the bulk of the 2008 to 2009 crash, getting out when the market was about 6% down. It would have then had you buy back in a few months after the recovery began, missing the first 10 to 15%. The worst of the 2011 fall would have also been missed, along with a good chunk of the 2015 to 2016 bear market. There are periods when this chart looks very noisy, though, and would have given choppy signals, particularly in 2010, late 2014 and early 2015, and early 2016. Some of this is down to the length of the time period. Zoom in on narrower time frames, and it is clearer, as you can see in the 3-year chart below. But some of it is also because even this simple method has its problems. Ultimately, even with a very simple rule such as this, you will probably foul things up. And that's why those hold tight experts have a point.